just in a few lines, right? Can you justify, not justify, sorry, can you explain to us, right, how you tahan all the volatility with Bitcoin? Are you already in the money, in the positions, or are you
Actually, I have prepared an entire. I'll walk you all through the thesis of like what I do and why Bitcoin in the first place. Okay, but it will be more of a macro lens. And should I begin now?
Yeah. I think if you want to share a screen, let us know, lah, because some of us could be on audio only by listening on their phone. So if you got screen sharing, let us know.
Maybe I'll do up some slides later, but I don't have any screen sharing right now. Lah. I can put out some charts in the chat itself and put out some statistics in the chat itself. But as and when that will come, then when I'm talking, then I'll just post a screenshot there. Lah. Okay?
Okay.
Yeah, sounds good.
Okay, so I'll just begin with a very simple question. The simple question is, why do you invest? So majority of us, right, when we invest, we only have there are only two things that people invest for, okay? Because investment is something about long term. That means you are putting money in now, and in the long term, you are hoping to get more out of your money. So there are only two goals in investing. One is to grow wealth, the other is to protect wealth. And these two goals is actually because inflation destroys wealth. So it's a very simple concept to get, right? If you hold cash, like you put money inside your piggy bank, like as a kid, you put money inside your piggy bank. 10 years later, you look at that money, you are actually losing money because there's inflation. So now we look at the other concept, which is debt. So what is debt? Debt is borrowing money, right? But borrow money is borrow from who? You think that is borrowed from like other people and things, but actually the real thing is that debt is borrowing money from your future self, right? Because you're borrowing money that you can spend now, but in the future you have to pay it back. So debt is used for two kinds of things. The first thing is investments, is a good debt. The second thing is spending, which is bad debt. So I'm sure you all know what's the difference between good debt and bad debt and what is considered good and what's considered bad. So I'm not going to explain more on that. But debt is given out based on two things, assets and income. So the more assets you have, the more creditworthy you are. The more income you have, the more creditworthy you are. So that's also given, you all know. When you have assets and you bought assets through debt, then that is called a liability because you will balance out assets that are bought through debt, you have liabilities. And because businesses need debt to expand quickly, they will borrow money. So they borrow, they create the liability, they buy the asset. So this on their balance sheet, it balances out, but it's good for them because if their assets generate a yield, they are getting more out of it. So that is how that's how the system works. When you zoom out to a country level, right? Countries also borrow money. And when they borrow money, remember I said it's borrowing money from the future self. When countries borrow, they are borrowing from future generations. And then also they are borrowing from other countries. So, but then when you borrow from the future generations and from other countries, right? Eventually the debt has to be paid back. You can't just like say, oh, I'm just going, it's on the paper itself that you owe how much, then there's this asset that's how much. You don't just like burn away the paper because it just doesn't work that way, right? So how exactly do countries pay debt? Countries pay debt in three ways, okay? The first way is productivity growth. The second way is reduce consumption, reduce debt growth. And the third way is money printer. So these three ways, they all contribute to tax. So there can be all kinds of tax. Okay, there's like corporation tax, there's like tax, there's property tax, there's consumption tax, or business tax. All these are all taxes. And uh and when countries they have to pay debt, right? these are the three ways where they do it. Obviously, the first one is the best way and what all the countries' ideal outcome hopes for, which is that productivity grows faster than debt grows. And when productivity grows faster than debt grows, you are able to reduce down your debt over the longer term. But when there is some kind of like recession or some kind of spike, some kind of crisis event, what actually happens is that there will be businesses who default. They default because they have debt. They are unable to pay the debt because of some kind of conditions. They need help. So when they default, they need to the government needs to step in to print money or it's either they print money. Okay, there are many different ways of printing money. I'll go into that later. They print money so that people they can keep up the demand. So these companies are able to ride out this rough wave. Okay, when they ride out this rough wave, then they don't close down. They keep people employed, and these are all good things. The economy continue on. But the thing about money printing is that you can only increase demand. You cannot increase productivity directly, right? You can have different kinds of rules that say that people can borrow more debt to do things when whatever, but you can never even if they borrow debt to go and buy assets to go and invest, there's always the risk. There's always the default risk because yes, they borrow money to go and buy all these assets, right? But because productivity is not something that you can overnight you just say, oh, everyone is going to be super productive, because productivity it only increases with innovation, right? And to increase that productivity, you need to have education, you need to have automation. These are the two kinds of ways to increase productivity: more skilled labor and more automation, essentially speaking, which is technology. And so when you print money, right, you can only increase demand. Productivity increases relative to this demand, but it's not a one-to-one increase in productivity. Okay, and when you print money, the more you print, the more wealth is wiped out, because the wealth is built. The wealth is because when you print money, there's inflation, and then while the Federal Reserve, right, might say something like, oh, we are printing money and we print I mean, they don't say they are printing money, but they have four different ways of printing money right now. The first way is the most classic way, which is interest rate adjustments. So these things you all know already. When you adjust interest rate high, people need to you all get it lah, okay? Then the second way, which you see in 2008, 2009, is QE, which is the Troubled Asset Relief Program, which is the Federal Reserve go and buy bonds. Okay, they buy all the bonds. The third way is that, which is actually in 2020, you start to see the Federal Reserve buy commercial paper. Okay, then after buy commercial paper, then now you see the fourth way already. The fourth way is that the Federal Reserve do stimulus checks. So these four ways they are actually all just printing money. But you can see that once the Federal Reserve use up one particular one, right, it moves to the other one, because they needed to create more stimulus for the economy, because the first way is already used up. Like interest rate is already used up. It's already at very low, 0.25. It can't go lower. If let's say it goes to like negative, then there's going to be consequences, because who want to deposit money, and then if I deposit $1 and then 10 years later I take out 95 cents, who want to do that? It's quite hard. Okay, so these are the four ways that the Federal Reserve prints money. And when the Federal Reserve prints money, you can see that why they have to do this is that a lot of this money, yes, is going into assets, which implies that these assets are purchased through debt. Okay, that's why you start to see over the past 20 years, you see your PE ratios, it keeps going up. Is it really true? This thing is a more of like a, is it really true that your company is actually going up so much in earnings? It's not, which is why the PE ratio goes up, because your revenue growth and your earnings growth is not reflective of the market price. The market is pricing it higher, right? Your earnings growth, maybe, I don't know, I'm just giving a rough example, like maybe say Apple grows by say 20% this year, or 20% a lot, but then you look at the price of the stock. If you are talking about a normal situation, price of the stock, let's say we don't talk about like other things, we just talk about just this. If you see that something is earning 20% more this year, right, then the price of the stock should logically be 20%. But then what you actually see now is across the board, the PE ratio rises faster than this 20%, which means that a lot of these assets, a lot of this equity, whatever you are looking at, property, stocks, they just go up because, yeah. And I mean, if you, by the way, for property is also is a measure of like how much rental income you can get, how much yield you can get. So it could be 20 years to pay out your original. That means 20 years of rental to pay out. It could be 30 years. All those are the numbers. Okay, so this is the current backdrop in which the economy is built at, which is that we have assets that are built by debt. Okay, now when the monetary policy is so loose, right, the situation becomes too much money chasing too little goods. And you can see that right now happening in play, which is that prices are going up. You see in your everyday prices, I mean, maybe not so much in Singapore, but if you try to buy online things, I mean, if you are a gamer, you try to buy GPUs, let's say, for example, you see that the price of the GPUs is up. Too much money chasing too little. You see, you go and buy other things, and now even let's say you go to the supermarket, Sheng Siong or whatever, to buy stuff, you see that things are more expensive. And this is inflation. And when inflation happens, right, the Fed has a dual mandate to control it, which is one is to control employment, the other is to control inflation. And the Fed has to control it because otherwise wealth will get destroyed. Because if inflation, like right now, this year inflation is already at like I think 5% plus already, and we are projected to have like 6-7% around there for this year, US inflation rate. So the Fed has to control it, or the wealth gets destroyed. And this debt fueled growth without curbing consumption, right, is unsustainable. Because if you keep printing money, and the money, right, does not go towards raising productivity, it goes towards consumption, it becomes a too much money chasing too little goods situation. And when the Fed tightens, right, the demand goes down. That means the Fed tighten the money printing, stop money printing or reduce. The demand goes down. Then if the demand goes down, many of these debt purchase assets, right, they are going to get a lot of exposure. The exposure is because they do not generate enough yield to pay back the debt. Because so if that happens, assets will go down in price. There will be some assets that, if you remember in 2008, what happened is that prior to that, the Fed increased the rate a bit, just a bit only, and then these bonds that were graded at like investment quality, right, actually turned out not to be that investment quality after all. Then what happened from that was there was a cascade, because when some of them default, there's many other derivative structures that's built on top of this structure, then they also default. And then when the cards come collapsing down, right, it will be like a game of musical chairs, whereby if you're not sitting in the right chair, right, what will happen? What will happen is that there'll be no chair, or you'll be left holding the debt, and the debt is going to be bad debt. So in this kind of situations where people default, right, or where people are afraid of default, they will run to safe havens. Is when they run to safe havens, right, it could be all kinds of safe havens. Some people could be like, oh, I'm going to run to a company that I know is going to have a lot of cash flow. I'm going to run to a company which I know it has very little debt. It could be that. Or it could be running to property. Run to property is, oh, I'm going to ensure that I hold the property and I believe in property, these kind of things. But you realize that if you hold property, you hold equity, yes, they are very good. They generate revenue, they generate income. But if you look through most of the property, you look through most of the companies today, like just look at your favorite company, whatever favorite company that you have, that the most allocation you assign to it, right? What will happen is that you see that they have debt on it. So no matter what, you are exposed to some level of debt. It could be through the stocks you purchase, it could be through the property you purchase, because these are all propped up. So there's counterparty risk. This is called counterparty risk. Okay, so when you have something like this, and the game of musical chairs stop, you want to be sitting in the right chair, and when that happens, right, you realize that if you look at it through this lens, you start to look at it, you start to look at the different asset classes. In the event of a crash, what asset class is the most unable to change, most that people will run to, or that the most that when people don't believe in when people don't believe in the reported numbers, right, that there's out there, because media can lie to you, people can fudge books, and in the event of some kind of things like a crash or something, there's even more incentive to fudge the books or to do something like that. Then you look at the different asset classes. You see property, you see equity, you see commodity, you see gold, and you see Bitcoin. And then, as I mentioned, property and equity, they are good, but they have counterparty debt risk. When you talk about commodity is very affected by demand and supply. So if let's say there's a recession, right? Yes, the production of that commodity might be low, but then the demand might also be low. So it might just be low together, correct? Then you talk about gold and you talk about Bitcoin. So gold is the traditional hedge against this kind of recessionary problem, which is that it is recession proof. You can have a huge recession and people might flock money to go, like how you see in how you see it during like the Great Depression kind of times, okay? And what's the reason for gold is because there is no counterparty risk. When you hold gold, right? If you hold 1 kg of gold at your home, physical gold at home, no one is going to be able to like say, oh, you don't have 1 kg of physical gold. You have that one physical is locked up in your safe or something. It's possible, right? So then you also look at Bitcoin, and then you think about Bitcoin, which is that if you I'm not going to explain on like the kind of things about Bitcoin or what are these what are its characteristics, but you realize that Bitcoin shares the same kind of zero counterparty risk as gold. Okay, and then you think, should you actually allocate a bit of money to at least hedge against these kind of scenarios happening? And that is the reason why when you look at, then you look at, is the scenario of this defaulting this defaulting thing likely to happen in our current world. So when you look at that, you can start to see, start to look at the debt to GDP ratio. So you all know what is the debt to GDP ratio of the US? Has it been going up? Has it been going down? Anyone knows?
Up. I can share the screenshot, like you can continue.
Okay, so if you look at total debt percentage of GDP from 1950 to December 2020 I mean there are little drops down but it's a one-way up. So it's around now 800% already. Okay, that means 800% means remember, borrowing is borrowing from your future self. It means that US borrow 8 years into the future. They have to work for 8 years to pay back. Okay, and that's assuming that they can even they are not adding any more debt to it, which is quite unlikely. They will still add more. Okay, and then you look at other signs. Anyone knows what is the Federal Reserve balance sheet? How has it been? The Federal Reserve has a balance sheet. How many assets is on their balance sheet? Anyone knows what's the number like? It's also up all the way. But if you look at recently,
8.2.
Yeah, it's also up all the way. And you look at recently, right? You look at in March. You look at the March period. It went from 4 trillion to how much? To what's this number? To 7 trillion. To 7 trillion in about 2 months. Okay. Then it dropped down. But then now you look at the number. Do you see there's a very odd pattern now? The odd pattern is that it's actually going up all the way now to like 8 trillion already. So is it really the economy has returned to normal, has opened up, or is it all the demand is fueled by this purchase in assets by the Federal Reserve? That's something to consider as well. Okay, because we are still in this coronavirus epidemic, and the economy is not fully open. There's the productivity has not come back in force. But somehow you start to see all these stocks, record profits, you start to see, this year S&P go up by 10%, 20%. I mean, you all can see on your accounts. But how much of it is actually the Fed? Remember, the Fed is doing what? The Fed is doing stimulus checks. The Fed is doing commercial paper. These are all directly money. They are going somewhere and they are going into this kind of things. And yeah, okay. So then you also start to look at like this is another thing that I like to look at, which is that you look at all the big fund managers, the big risk managers in the world, okay, like Warren Buffett, Ray Dalio, or this kind of people, whoever your favorite one is. You look at, don't listen to what they say, okay? What they say is actually most of the time bullshit or whatever. Okay, just look at their fund, what they hold. Then think about it. They are the people who are owning the billions in their fund. Why are they holding it this way? Why is it that Warren Buffett's fund holds about 100 billion plus in cash and has been increasing that number over time? Why does Warren Buffett hold short-term bonds? Yeah, I mean, clearly it doesn't make any sense to hold short-term bonds if you are so bullish on equities, right? But still, he holds 100 billion plus in short-term US bonds. Something to consider. You just look at all those favorite fund managers or whatever, and look at their portfolio, what they hold, because I believe that their action speaks louder than their words. What they hold is more reflective of what they think of the current economy. Okay, so these are the backdrops of what exactly is the current economy now. And when you look at it from like a long-term debt cycle, when I talk about long term, because investing is long term, right? You're not looking at time spans of like 1-2 years like that. You're just looking at time spans of like say 10-year cycle, and you know that you just look throughout the history, right? You will see that 1997 there was some kind of crisis or whatever. 2008 some kind of crisis, whatever. 2020 we have this coronavirus thing, whatever, right? You go back all the way, you see that approximately every like 10 to 12 or 13 years, right, there's this kind of thing happening. Okay, and we are not out of the woods yet with this coronavirus. Even though the numbers might show, wow, very happy, everyone reopening. But when you look at all the balance sheet of the Federal Reserve and you look at the debt, then you realize that, hey, actually the picture is actually not that rosy. Because if things are getting better, right, you should start to see the debt go down, maybe go down even slightly, but right now that is not the case. Right now the debt is still going up, and you look at Biden's policies, you realize that debt will still continue to go up. Okay, and if let's say the Federal Reserve runs a very important thing, which is that right now it has its hands tied. Okay, its hands tied is because there's not a lot of things it can do. Federal Reserve cannot increase productivity. Federal Reserve can only increase demand. Okay, it can only increase demand because it only has the money printer. Okay, and when it only has the money printer, and if let's say it decides to tighten the policy, right, it will run the risk of this kind of another great recession happening. They have to be very, very careful if they want to like tighten policy in any sort of way, because it really can lead to this cascading kind of effect. Because the traditional commercial banks in the world right now, all of them are around 15x leverage. Yes, they are. If you deposit money in a US bank, right, the US bank is taking your money to do 15x leverage. Fractional banking reserve, right? Very fun. Okay, so this is the kind of things that's happening today. And then you might just think, hey, print money is actually good, right? Print money means that more people, but when you print money, if a wealth gets destroyed, but then you think, oh, okay, so but then US is the world reserve currency. Okay, world reserve currency means they have benefits from being the world reserve. They are a safe haven. Whenever there's uncertainty throughout the whole world, people won't go into USD and things. Then you think about, okay, so if US keeps printing money, then it also means that their exports are more competitive, because you debase your currency, you are able to export more, you are able to clear your debt better, right? This is just you all know this thing lah. But then you realize that everyone every country in the world is actually, they are all aware of this thing, and they are all printing money. Everyone wants to print money, because if you don't print money to keep up with the US money printer, what will happen is that your currency will go up, your exports will be less competitive, and when your exports are less competitive, when your exports are less competitive, right? The sorry, give me a while. When exports are less competitive, you'll find that you might have issues trying to clear your own debt, because countries also have their own debt. You can just look through the debt percentage ratio to their GDP for a lot of the countries. You see that most of the mature, developed, big countries, they all own some amount of debt. Okay, and when you debase but then no one can debase their own currency as good as the US, because the US by default is the world reserve currency. Okay, this policy itself, there's a term for it. It's called beggar thy neighbor. Beggar thy neighbor. Okay, and this thing is actually something that has been around since 1980s. You will see that it's been around, and it's not something new. Okay, it's just that the US world reserve, they have a natural advantage at printing money. Okay, and then you start to think, hey, okay, so this is the doom and gloom scenario. I've discussed about all this. I've discussed about cascading effect, about recession, about defaults. But you see, when I look through history, I only see one time in which it default, right? During the Great Depression time, or things were bad. The index for the next 5 years, they went down by, it didn't go up as though like the the typical, oh, you invest in index fund every year you go up by whatever 7, 8, 9%, this kind of thing. But then if you look at the Great Depression period, right? If you invest during that time, every year you will see that your money actually drop by like average 30%, drop by 30%. That means you put $1,000 in, the next year is less 700. Then after that 700, you hold. I'm not talking about holding one company. I'm talking about holding the index. Then 700. Then 700. The next year you see that the 700 take away 30% again. This continued for about 6 years. 6 years, okay, before it finally go back up. So if you put $1,000 in at the start of the Great Depression, to get back that $1,000, it took roughly 9 to 10 years, okay? 9 to 10 years. Okay, so that is considered long term. If by my books, long term, you put in 1,000, 10 years later, you get back 1,000. Okay, and not even guaranteed, because you don't know whether some of the ETFs might have issues, right? Okay, that's another thing to see over there, because as you know, you buy an index. This index, they are just running a very simple maths system, whereby they rebalance and they just put money into whatever goes into their index, whatever goes into their ETF. They are just based on some rules. But then, because they have a lot of influx of cash going into all these companies, if these companies have issues, they also have issues. Okay, it's all counterparty risk trickle down. Okay, and then you think, hey, but I only see Great Depression US default once, right? But did we see any other defaults? And the answer is yes. There has been multiple defaults. It's not explicit default. The US never come out and say, oh, we are going to default on our things, because frankly, the US doesn't need to. After World War II, which they won the war, okay, how they won the war? They won the war because every other country were bombed or attacked. They had their factories destroyed and things. US is the only one whereby the only losses they have was in labor, in people. But then all their factories, all their production capability is all still there. And because they were the largest contributor to winning the war, you see that US has the most amount of gold, because back then money is still pegged to gold, and the more gold you have, the more valuable your currency is. So after World War II, there was a tacit agreement by all the countries to like just say, okay, we're going to use USD as like the world reserve to transact our currencies in. But then this worked well for a while. But what happened was, during 1960s plus, Vietnam War happened. And the US needed to fund the Vietnam War, right? And to fund the Vietnam War, it really cost a lot of money to continue the Vietnam War. And that's why during 1970s, right, there was an implicit default again. And you all know that by Bretton Woods. Because the US decided to, okay, we're not going to peg to gold anymore. We're just going to make an agreement. Everyone just go free floating. Why they don't want to peg to gold? They don't want to peg to gold. One of the reasons is because they don't have enough gold. Okay, so they just move off that gold system, and then they just say, oh, now we are all free floating. And just by that agreement, what happened is that a lot of their Vietnam debt is wiped out, because they don't need to. They essentially just put a clean balance sheet again, and then they can start over their economy again from there. So that was already an implicit default already. And if you think about money printing is essentially a form of implicit default, right? Because if you owe me $100 and then you don't have enough money, then you just go and write on a piece of paper $100 and pass to me and then say, nah, $100. Then your overall currency, actually there's more money in, you are actually devaluing my debt. You are devaluing, you owe me debt, then you're devaluing my debt. That is what exactly is happening. Okay, so these are all the things that's happening, and you can see that I don't know how the default, how the US might manipulate their economy or system or things to happen. But all I just know is that I'm looking at these numbers. I'm looking at, say, the amount of trillions in the Federal Reserve balance sheet. I'm looking at the amount of percentage of debt growth, percentage of debt to GDP ratio. I see, hey, these are all going up. And if economy is doing well, why are all these just keep going up? Okay, and I think, should I actually buy some amount of insurance against this? If I want to buy some amount of insurance against this, what kind of insurance should I buy? So these are all questions that are very legitimate, because when you are investing, not only do you want to grow your wealth, you also want to protect your wealth. Yeah, right. That is the things, right? A lot of people get into investing because of one reason, because they are looking at, hey, inflation rate is going up 3-4%, 5% a year, and I have money sitting in the bank. I know inflation is happening. My kopi went from 80 cents to $1. I know it's happening. I must do something about it. I need to invest, right? So those are the kind of things, and it's good to invest in revenue generating, profit making companies and equities, property, all these kind of things. These are all good to invest in, but you must look at the overall long-term debt cycle to see, instead of looking at the very short-term, oh, this year what is happening, next year what is happening, because those kind of things you are not able to see, and you know, when a recession comes or something, it will hit suddenly one. It's not like, oh, there's going to be, we tomorrow having recession, no such thing one. It will hit suddenly one, and then when you look at your CNBC, you look at all your news sources, they'll be saying, oh, it's not happening, or whatever. Then they'll just report it like normal. Then only after it happened, then they say, oh, we are already into a recession. These are the kind of things that will happen. You all know, in 2020, you look at the news cycle, you see the stock go down together. Then you see that there was in between, there was like a small rebound. You think, oh, it's all right and things, and then, but you know, as things goes, things drop by 50%. You never know whether things drop by 50%, 60%, 70%, or whatever kind of thing. You don't know where's the bottom. Okay, and then, so when you look at all this and you think, okay, why do I want to buy Bitcoin? I just buy gold, like what you said. I think gold better. I can hold the gold at my own home. Okay, I can hold the gold at my own home. Then you look. Then this is where you look through history. You have to look through history to see what exactly happened in history. And what exactly happened in history is that the US, there's this Executive Order 6102, whereby during that time, the US actually just confiscated all the gold that retail consumers have. They literally just confiscated the gold. They just say that it's illegal to own gold, and if you own gold, we are going to take that gold away from you. This happened, okay? This happened. And then you think about it, then you think about how much of the assets you own, how much of the capital that you own is actually locked. They are actually not mobile. When I say not mobile, is that you look at all the current anti-money laundering systems, you look at all the current, you want to withdraw your money, it will take 1, 2, 3 days or something. Then, you want to withdraw your whatever money, there's a law that, you cannot withdraw more than 10,000 or something like that. These kind of laws are all in place there. They will tell you that, it's anti-money laundering, it's just this, we need to do checks and all these. But the whole reality is that if you have a lot of money sitting there, you cannot just instantly take out your money, because your money is actually not your money. You are actually owning a receipt for your money. Your money is actually with the bank, with whatever other counterparty, and you actually have to go request from them to get your money. And that request can be refused because the government can just pass some kind of thing, some kind of law or capital control that say you cannot withdraw your money. It happens in a lot of countries. It just hasn't happened in the country of your choice yet. Okay, but it happens in a lot of countries. I mean, you can also look at India, that kind of things. And then as you know, if there is a kind of black swan event like this, and you are unable to withdraw your money to a safe haven, what's going to happen is that you are going to take that loss. Okay, you're going to take that loss. There are some companies that will shut down, and they are shut down. Your money stuck in there because you never take it out fast enough. You will take that loss, and you will have to beg. You have to beg for someone to bail you out, because that's exactly what. And you'll see a lot of investors start to cry. They'll cry for the government to bail them out. But then you also realize that you can cry for that, but are you willing to take the risk of the government bailing you out? They may or may not bail you out, That's the other thing that's over there that's thinking about. So you can hold gold, and if you hold gold you're not holding the physical gold, right? And even when you're holding physical gold, people can confiscate from you. But maybe let's say you're not holding the physical gold, you're holding gold in an account. Remember, when you're holding in an account, is with some other party, that some other party can choose not to give to you one, okay? Yeah, that is the truth. Or there's some other party, the government can just introduce, like say, we will liquidate some amount of your this, everyone pay for it or something. That kind of thing. I don't know what kind of things can happen now, okay? It can be taxes, it could be anything, and the government can do these things. So the question is, if you buy all these things and you are buying just the receipts for them, are you really protecting your wealth? Yeah, you are definitely growing your wealth through all these things, but do you have protection for them? That's the question. Okay. So when you get to Bitcoin, is that you all know that it's a decentralized network and is run by miners, and miners has essentially very little control over like what kind of transactions are bundled with it. Okay. And is that I can send some amount of Bitcoin to another address, to your address, to some other address, to someone in the US, I'm in Singapore, to someone in the US, to someone in the UK. I can just send it. And this capital is mobile. It's global. And not only that, I know that the network will just keep growing. There's a lot of people who put in a lot of effort into it. There's a lot of people, the use cases of it are growing daily. The layer 2, layer 3 solutions are being put on top of it. But most important of all, I know is that if I own Bitcoin and I own it in my own cold wallet, no one can take it away from me. That is the truth. There's only going to be those 21 million Bitcoin and the fractions of it. And if you own it and you put it in a cold wallet, you don't put it in a custodian, no one can take it away from you. And that is the reason for Bitcoin. You can hold gold, but gold people can take it away from you. I truthfully be told that. But how are you going to take away the Bitcoin away from you? You can't, because the Bitcoin is literally like just those. It's just a string, and with that string, you access your Bitcoin. And this is a hedge against the long-term debt cycle, and that is what exactly Bitcoin is. And when you think about it from this way, don't you think that at least you should put a bit of money or whatever, you hold some amount of Bitcoin, that no matter what, it will be static. If you hold 1 Bitcoin today, 1 year later, it will still be 1 Bitcoin. 10 years later, it will be 1 Bitcoin. It's like a piggy bank like that. You put the Bitcoin inside the piggy bank, it will always be that 1 Bitcoin. It's not going to change. But it's not like when you are young, you put the money, you put the $1, $2 into the piggy bank, and then like when you are 15, 16 years old, you take it out or something, and then you realize that, hey, that money, actually the value dropped already. Actually, you shouldn't have done such a stupid thing whereby you put money inside the piggy bank. Correct? With Bitcoin, you can do that. And that is the whole idea of why Bitcoin, because it's a hedge against the long-term debt cycle. Yeah, and that's my entire speech.
Wow. Very, very well prepared, I would say.
So I can talk about the Bitcoin later because the same for 1,000 of altcoins that can do the same thing. It's just basically math, right? So first, you talk about the most common FUD thing that everyone has been talking about since 2009, like Jim Rogers, the fear, everything fear. So okay, US debt to GDP 110 to 120 is actually pretty low compared to Japan, compared to China. China about 200 over %, but it's domestic, purely majority domestic debt. So it's actually quite reasonable amount percentage. And not only that, the banking sector has also improved in resilience. Since the CET1 Basel III, 2009 CET1 was about 9 for JP Morgan. Now it's about 15. I think 15, close to 13% already. So banking now has improved tremendously. They have a lot of buffers. If you look at China itself, China Bank, you talk about shadow banking, okay, but the thing is they have given allowance for their NPL to about 200 to 300% of allowance. So the banking system is where the recession or the depression hits. So these banks now are much stronger than they are in 2009. And talk about printing, inflation, the normal scale of inflation, talking about for 10 years really. So you look at the performance of gold, it's not performing that well for long term. And inflation-wise, from 2009 until now, it has not moved. So it's very, very low. Even now, 70% of independent economists say that it's transitory because pent-up demand. And also, there are also two other headwinds against this, which is technology. You look at last time, you look at DVD players, DVD movies is so expensive. Laser disc is about $30, $40. Now look at Netflix, Disney. They call it every movie together. You need to pay a fixed small amount every month to watch everything. So everything is actually becoming cheaper. You look at groceries, groceries or daily things, chairs, everything. Look at Taobao, Alibaba, all are making things cheaper and cheaper. So actually, there's actually two deflationary action working against the normal inflationary action that's coming. So I would think that, as you can see now, the lumber price has dropped below, the lumber futures has started to drop below 1,000. So inflation, I think it will slowly move down and go back to mean reversion. So, I mean, basically, all this is like a history lesson, in what he said, or it's the same as what Jim Rogers said, or this that a lot bad, print bad. But as Bunti said already, and most of the economists say, fiat currency printing is a function and not a bug. It's meant to help businesses to recover and to survive. It's a more proactive approach, and so far it's been working. And the bank has had no of this risk for a very long time, and they have been buffering up. They have also introduced Basel III. So all these perpetual bonds are all Basel III bonds. So let's say if the bank bonds were to default, right, they don't have to return the money back to you. They can just convert back to shares, or they can just write off. It's actually beneficial for the banks, all these perpetual bonds. So then you say what? Inflation coming, buy to go, but you guys have been holding on to go for 20 years. How's the performance? And then you say, okay, now there's a new thing called digital gold, Bitcoin. But Bitcoin, yeah, you say it's limited, but it's just maths, right? You can have, there's 1,000 over altcoin that can do the same thing as you. They can print, they can transact faster, it's more secure, and Bitcoin is it's almost a decade old, It's during the time of portable DVD players, So the technology now is leap and bound, is way ahead of Bitcoin, just like Excite, Netscape, all this. During that time, people say, wow, it's hyped up, man. Yahoo all-time high. It's the same thing. I would say the same thing. There's over 1,500 cryptocurrencies. They are newer than Bitcoin, and they are more efficient, faster, offer features that Bitcoin lacks. Limited also, you can do it. It's just maths, right? So, and then it's just basically who can innovate better. Like, there's someone is bound to lose. So if for me, I mean, if you talk about trying to hedge against inflation, the basic one is still gold. I mean, what's wrong with that? And then majority of the funds, they hold a small percentage only. You look at all the funds that you said for all the funds, right? Are they holding on to Bitcoin? Are they holding on to 50% of gold or something? No, right? So I would think it's still hyped up fund, yeah.
So you bring up many points which I find fair, okay, and I'll try to address them one by one, and if I miss out any, you let me know, then I address them again, okay. So the first thing I'll address is that you talk about other cryptocurrencies and how they are more innovative and things, but then I think that there's a fundamental misunderstanding over there, which is that the problems that Bitcoin solve and the problems that the other cryptocurrencies solve, right, is somewhat different. Okay, the somewhat different is that you look at other cryptocurrencies. They say, oh, we have more the typical kind of surface level 3-4 hour understanding of it is that, oh, we have more transactions, we have cheaper fees, we have whatever so far all these kind of things and we can do more of these, and we have even more limited supply, or we have some kind of mechanism or things, and people can gain yield from it, whatever all the kind of things that are all tied to it. These are all the other cryptocurrencies that are there. And you think about it is that there are so many cryptocurrencies, but how many of them are actually rug pulled? Okay, how many of them are actually not truly decentralized, or they are pre-mined by the developer themselves? The developer hold a huge amount of it, and the distribution mechanism is not a fair distribution mechanism. Like, let's say you talk about ETH. ETH has no cap. Okay, ETH forces the miners to always keep up to the latest, which essentially gives the developers a kind of control. Because if you don't keep up to the latest, then there's going to be a difficulty bomb, and you're not going to be able to mine any ETH to continue on mining. So there's this kind of things, and then ETH right now going over to a proof of stake, and proof of stake means that the more stake you hold, the more you get, which is kind of like the current financial system right now. So, and then you can say that, oh, ETH has more innovation, they have a programming language tied to it, they have this, they have that. But then the same kind of things can also be built onto Bitcoin. It's just that it's not built into the base layer. It's built onto additional layers on top of the Bitcoin. The whole purpose of Bitcoin is very simple. It is a ledger that cannot be changed because it's very decentralized. And if let's say you want to own a lot of you want to own like a lot of mining equipment, like really 51% worth of mining equipment. If you own so much mining equipment, right, and you destroy your own network, you are essentially just destroying your own wealth. Okay, these are the things going on for it, and it is actually because the network itself is secured by this proof of work mechanism. It is very difficult to tamper with it, and that is value proposition, which is that all the other cryptocurrencies out there, they do not have that level of mining, that level of proof of work dedicated to it. They do not have that capacity that Bitcoin has, which is why you're not going to find enough miners for those people, for those other cryptocurrencies. You're not going to find enough decentralization for other things. Like if you do proof of stake or whatever kind of other distribution, you're going to find that some people might be controlling it and these kind of things. And you say that Bitcoin has no innovation, but if you go and look at the Bitcoin repository, it has been innovating every year. It has been adding on more and more functionality every year. Like now, like just talk about some of the innovations that Bitcoin has. It now has multi-signature, which means that to access a certain amount of Bitcoin, to access a certain address Bitcoin, you probably need you need multiple signatures to access that, and that this can allow you to like create all kinds of handing over the Bitcoin kind of situations. Then you talk about like things like, say, the recent things that they do, which is that they build it to be more anonymous, to be stronger, and even the algorithm for the proof of work itself, right, the SHA-256, right now they are still using that, but there's already a proposal that's out there that's introducing a new proof of work mechanism for Bitcoin itself, that is going to make it to be quantum proof. So these are all innovations that are designed towards securing the security of the network, securing the scale of the network, and that is its core purpose. That's what Bitcoin is doing. That's what its developers are doing. And when the miners, because they are the ones who can pick up this, the miners and the ones who are running the nodes, they are the ones who can pick up this new code, right? They have a choice whether they want to pick up the new codes or not, and they are able to do that because they say that, hey, if this thing is beneficial to us, we'll pick it up. If it's something silly, like someone just push a code that say, hey, now we are going to increase 10 million more Bitcoin, everyone will be like, why would I want to destroy my own wealth? Then they will not just pick up their code. And anyway, such a proposal is too out of the way. No one wants to destroy their own wealth, so no one will even do something like that. So these are the kind of things that differentiates Bitcoin from the other cryptocurrencies. Okay, then you talk about gold not going up and things, and that much is true. Gold is not going up and things, and that could be because of it could be because of other reasons. It could be because of, like, the younger generation does not like to hold gold. That could just be simply the reason. Younger generation does not think that gold is a good holding, and it kind of makes sense that gold is not a good holding, because why? If you want to hold gold and you want to hold it as a hedge against recession, I don't say inflation. I talk about like recession and hyperinflation and deflation. Okay, inflation itself is a normal thing. The countries typically have a 2 to 3 to 4% inflation, but when it gets to the hyperinflation zone or the deflation zone, that's where that's what the hedge is against. And when you talk about gold itself, yeah, the price has not been looking good over all the time, and it has been going down all the way. But it could just be due to popularity. It could also be due to other factors, which is that the gold itself is majority of it is in a custody. Majority of it is in custody. You are not actually owning the gold you buy. You don't actually hold the gold you have, but you are actually putting all the gold into some custody, and then whoever is holding the custody, and through whatever other derivative mechanisms that they do, they actually earn from holding that gold, because they do derivatives, they do futures, they hold so much gold, they are able to manipulate gold down, and because it's all in custody, you can't really do much about it, or you can't really go and verify, oh, how much gold you have, how much gold you don't have, that kind of things, because they are just holding it, and you are not the one holding it. You are not the one doing the audit every month. You're not the one doing the audit every year. You don't exactly know how much gold they have. That's the other thing about that. And then the other thing about gold is that what's the last one? I remember the thought about it just now. Hold on. Oh. Okay, never mind. If I remember that, I'll say that later. So these are the things that's going on for gold. Okay, so I addressed the why not other cryptocurrencies part, and I addressed the gold part. So you talk about other things, which is that, okay, so it's actually not that bad. The things are actually acceptable. Other countries are going up as well, their debt and things, and is that what you talk about? Is that the thing about the debt thing?
Anyway, you haven't really replied the Bitcoin. Bitcoin, there's a lot of problems to it. The programmability of it is very basic. It's very basic, and you know previously. I mean, they only allow basic programming. It's like, you mean you own Bitcoin, you don't know about it?
No, what do you mean by basic?
I mean, Bitcoin is prevented from being used in more complicated situations like smart automatic executing contracts, all this, you know.
But there are already
You cannot
people
compare
who are
it with
building
Ethereum, you cannot
other
compare it with
layers.
Ethereum. And then there are a lot of purists in Bitcoin. Last update was November, was sometime back. Then it was cancelled due to lack of community support. And then the update was meant to introduce SegWit 2 times, which is a means of increasing number of transactions like recorded on each block. But then it was scrapped. Then this Lightning Network, this Bitcoin now mythical response to this more testing is necessary. Because the thing is that there are a lot of shortcomings in all their upgrades. And even if you do hard fork, right, no one uses it also. Yeah. Like Bitcoin
I think
Cash.
it's a fair point. I think all these are fair point, but I just have to jump in, right? Because I think by saying that Bitcoin has basic programmability and in many cases is a shortfall, right? I think it depends on how you look at it, right? Bitcoin is kept intentionally by design, right? Its source code to do very limited operations. And that's because, right, it's now securing hundreds and billions of dollars on its network, right? And at some point of time earlier this year, $1 trillion, right? So you can't have malicious code going on with it. So depending on how you view the Bitcoin, how it's being structured, how it's being built, right? It can be both ways, right? And if you are looking for something that's a bit more open to programmability, right? There are like other smart contract network, right? Like Ethereum, Cardano, who's doing exactly what you just mentioned, right? So I think there are options out there. And I think earlier you also mentioned that Bitcoin there's like 5,000 or 10,000 over competitor. I think these are also not fair argument because you can't compare something that's built to be resilient as a hard asset, right? Like money, and compare against like other projects that's doing other things. It's as good as saying that you're building a payment network for pay now, right? And then you're comparing against like Telegram, Netflix, Twitter, right? There's no like one-to-one metric that you can compare against. So they are not apple to apple comparison. So hopefully that addresses your point on that. But it's a good point that you raised. And I like the conversation today. I never feel so awake on a Sunday. #work. Back to you.
Okay, so when you talk about things like the SegWit 2x thing, it's actually by design that there was quite a huge community for during that time whereby people debated over what should be the right thing forward and things. And eventually it was settled on that not going to pick up on SegWit 2x. But that is the nature of a community, right? It's not that everything that some developer puts up, the community must accept, right? And that is the nature. You are seeing decentralized consensus, right, happening right in front of you. With that, people didn't want to devalue their own things, so they decided not to go ahead with that. They didn't want that. They didn't want to pick up that proposal. They didn't want to pick up that code. You are seeing that happen, and that's exactly what happened. And then when you talk about and then that is also one of the reasons Bitcoin the code itself it moves very slowly because there's so many eyes looking at it to see if there's any bugs or whatever. People contribute to actually like see, hey, is there going to be any kind of things? And then the rollout is slow, and intentionally by design it is slow because you don't want something to change that fast. But that doesn't mean that you cannot build networks on top of it. You cannot build additional layers on top of the base layer, which is Bitcoin, because Bitcoin's number one thing is to be a decentralized distributed ledger, okay, and is secured by the proof of work consensus mechanism. That is its number one thing. That's all it is. It's just a ledger, a ledger whereby you just write this address has this address has that, and this address is transferring that amount to that address. That's precisely what it is, and nobody can go and tamper with it and edit it. That is his use case, and he's doing that better than any other cryptocurrency out there. And there have been many cryptocurrencies that try to do something different, try to increase the block size, try to whatever. You see BCH, you see BSV or whatever, but none of them has taken off because there is momentum in the Bitcoin network, and people believe in this level of security compared to something that's forked off that does not have that many eyes looking at it. That is the thing about Bitcoin, okay? Yeah.
Go ahead. You want to speak?
So 1,500 cryptocurrencies, you're saying a Bitcoin is going to be a payment, a currency for payment, right? So how much of Bitcoin is adopted in this current world for payment? It's still basically a stock currency, right? It's like gold, basically. It's digital gold.
Now Bitcoin can be used for payment. Bitcoin can be used for payment, but as I said, Bitcoin is actually a network, and how people want to use that network is up to them. No one is forcing anyone to use it for payment. No one is forcing anyone to do anything, and that is the nature of this decentralized distributed system. And that is the beauty of it, which is that it is actually just doing what it does. It's not going to care about whether you are paying, you are using it for whatever payment or whatever thing you are, whatever value that you assign to Bitcoin, right? That is your own personal preference, your own personal kind of things. If you don't like it, it's also okay. Like, don't use it for payments. Don't use it for whatever. Don't buy Bitcoin. I mean, if you don't like Bitcoin, don't buy Bitcoin. You don't subscribe to the use cases of Bitcoin. You think that other networks scale better. It's okay to go for those other networks, and that is the beauty of it, right?
Yeah, actually, I have a question. Because today's topic is like we are talking about like, whether Bitcoin is a good investment or not, right? And then I think just now, in the opening introduction part, you mentioned a lot about, let's say, like Federal Reserve actions, fiscal money policies, stuff that would tend to inflate the whole economies, making fiat money less and less valuable, right? And then you also mentioned about the fractional banking that cause all sorts of debts, and then the whole system is essentially quite fragile, and then it might break, right? And then in the case that this entire monetary system break, the only one that's left standing will be assets like Bitcoin. Like this one, I do agree that it will be the case, because the others fiats are all tied together. Like you can't really get out, right? You have to be outside of this system to achieve that wealth preservation. So that's when gold and Bitcoins all come in. But I just want to know, like when it comes to allocations, right? This one, I mean, the whole thesis when we are using Federal Reserve, all these things, right, is mainly like we say, okay, Bitcoin is actually a hedge or an insurance. So what if the entire system break down? At least you still have your Bitcoin. So that's the main thesis, right? But what is the likelihood, right? Because let's say if we are talking about, okay, actually the fragility is quite high, and more than 60% chance it will break, or more than 90% chance it will break within 10 years or 15 years, right? Then if I come to this conclusion, I will put, like, let's say 80% of my wealth into Bitcoin. I think that's totally sensible. But the thing is, we don't know for sure, right? Because if you ask me to assign a probability, maybe I would just say maybe just less than 2% chance that things will break down. Because if you follow the history of quantitative easing, you know that this is not new. Since 2009 already started. And then back then, people already talking about like inflation, asset inflation will come in, and then everything else will be devalued, all these things. But what happens, right? You see 10 years after, nothing happened. Economy is growing, corporate is growing, economy is like really quite healthy, of course, until pandemic strike down. So the thing is, now standing here at 2021, and if we just project out, let's say 10 years, 15 years, right? I mean, what's the outlook, right? Whether it will be a situation where, okay, we're still stuck with the pandemic, and then banks default, and then QE 5, 6, 7, 8 all come out, and then everything devalue. Is that the base scenario? Or is it like a base scenario should be something that is more neutral, like, okay, we have a growing economy, things are doing okay, and then there isn't need for insurance, right? So, and then if we, on top of that, if we see that as an insurance, also doesn't make sense to put in 40%, 50%, right? There's always chance that I will just pass away, die in the next, let's say 1 year or so. Makes sense for me to buy a term insurance. But if I tell you I've spent 60% of all my saving into term insurance, does it make sense or not, right? Of course, 5, 10% is, I mean, some small percentage makes sense. But if you allocate something that is sizable, you want to be sure, have some confidence that this scenario that I'm hedging will happen, right? So that's my questions on the allocations.
Okay,
Maybe
so
can...
you have two questions over there. The first question is actually on the scenarios happening, right? The second question is on the allocation. So I address the scenarios happening one first, which is that I mean, you can talk about, like, say the things are doing well and all, but your doing well metrics are they actually nominal metrics doing well, or are they actually real metrics doing well? That part is a bit debatable. Okay, and why I say that is because when you look at the PE ratios, the PE ratios are going up a lot. Like, you just look at this year's PE ratio, look at 5 years ago PE ratio, you look at 10 years ago PE ratio, you will see that the PE ratio is going up a lot. And this PE ratio going up a lot is very risky, because you are just essentially like just pricing in all the future earnings inside. I mean, you're pricing in all your future earnings so if you have a 20 PE ratio, it means that your price is like 20 times your earnings, that kind of things. So earnings per share, sorry. So that is your PE ratio going up. Then you see, hey, my PE ratio is going up, and then the debt itself is also going up. Then you have to think in this way. Do you think that could the debt and the price be, is it a debt fueled growth, or is it really a productivity growth? That is a question that you can delve deep into it to actually to see, because that is the thing, right? And yeah, that's thing, like, and this kind of things. Then you think about that. You think about things like, oh, so let's look at the CPI, the inflation rate, and all these and then you realize that when you look closer into the inflation rate, you know that what they actually count for inflation could be very different from what you actually spend in your life. Like, if I remember correctly, the US inflation CPI doesn't even take into account property, right? But you still need to buy property to live, right? If let's say let's say now you allocate 30% of your income to property, 10 years later you allocate 50% of your income to property. That has increased, right? But the CPI does not take that into account. And there is another thing. And let's say for CPI itself, their metrics itself it does not follow the typical consumption path that people nowadays spend. And you have to also question that and think through on the ground, is it really the case? That's another thing to consider. So yes, some of the metrics are there. Some metrics are more debatable. Some metrics are hard metrics. Like we talk about, like, say, value of assets, the number of assets you have. These are hard metrics. But things like saying, oh, CPI calculation, things like saying, oh, these have more like these have more incentive to cheat around them, because if CPI itself is low, right, then the pensions don't have to pay out that much. Then the adjustments for the pay don't have to pay out that much. So there's actually incentive for the government to, like, say, oh, okay, we are going to ensure could be two ways. Ensure one way could be that we really do our work to ensure it. The other way could be we are just going to change the calculation to ensure that it is low, so that we don't have to increase our debt more. And these are things you can look into. Yeah, you can just see through the CPI how they calculate. Is it really reflective of the ground situation? Like Singapore can say, hey, we have 4% inflation rate, but then you see your whatever product rise by 50%, and is it really reflective of that? That's the thing. Like, yeah, those are things to consider. And when you talk about the asset allocation, right? Asset allocation, for me, I assign 40+% to it, and the 40+% I assign to it is because I've been putting in money over time. Okay, and I look at the Bitcoin network as a network that is growing. Is growing. There's going to be more adoption. Is getting more resilient. More use cases are being built on it. Built on these extra layers. More and more and more. They are just building onto it. This is something that and the other question, which also which a fair point brought up, why all these other asset managers, they are not holding onto Bitcoin? And the reason why they are not holding onto Bitcoin is it could be two kinds of reasons. The first reason could be that they don't understand it. The second reason could be that they want to, but they are not able to, because as you know, some of these fund managers, they hold billions, and if they want to invest in something, that whatever something needs to have a sizable market cap before they can go in. And even before they go in, they still have to like have whatever regulation governing that, oh, what exactly is this asset class? Can I put money into this asset class? Do I have to seek approval for it, and all these things? So these are the things that are doing it. And then there's also inertia, because inertia is that these fund managers, they see, oh, this fund is not doing it, this fund is not doing it, but then they start to see other funds doing it, then they will do it as well. And then some of them might, and when they do it, they don't do it instantly. They don't like say, oh, we are going to allocate 40% to it, but they might start small. I'm going to allocate 0.5%, 1%, 2%. But you see all the ramps in place for Bitcoin. There are all the ramps are being built now to actually put money into Bitcoin. And there's been multiple applications of ETFs to hold the Bitcoin. This all indicates interest in holding Bitcoin. It's just that the regulation has not caught up to it yet, and legally they are not allowed to. So these fund managers, they are holding on and they are putting it onto there. So that can explain for that. Okay, so and in terms of allocation number, right? I hold 40% because I have a high conviction to it, because I believe that the network will grow, and so far it is young and it has been growing, and from a pure numbers perspective, that's what I believe in. But of course, if you think that 40% is too much, you can put in whatever percentage that you want to. You can put in 0%, you can put in 1%, whatever number. That's entirely up to how you make up your own profile to go about hedging against these kind of things that's happening. And another thing I want to point out is that Bitcoin is not exactly a hedge against inflation. Bitcoin is a hedge against hyperinflation and deflation. Inflation is a normal thing that happens, and it's okay. This money supply is growing, and that's fine. But in an example of a hyperinflation situation, or in the example of a deflation situation, that's where things need to be more solid. People tend to go to the more stable things, that the value will not change as much compared to like whatever that's hyperinflating or whatever that's deflating. Yeah.
Just want to comment about the. Go ahead.
No, I just want to ask a quick follow-up question. You mentioned 40% that you hold in Bitcoin. Is that 40% of your net worth?
Yeah, it is.
Oh, okay. So okay, so if you consider that 40%, right? Like I just want trying to understand a bit also, like in proportion to the free capital that you're holding, right? So meaning the cash that you're holding, right? What is the percentage now? Now that we have zero in on a much specific class of
Cash is
asset that you're holding.
cash is just a rainy day fund. I hold the cash. I mean, I don't. there are many different types of cash I hold. One
Mhm.
cash I hold is in the bank account. That one is just a rainy day fund. Then there's other cash which is that I hold on my investment account itself. That one is to like say buy that one is called dry powder lah. The dry powder itself. That one
Ammo, yeah.
yeah. So I don't actually go and count that cash component. I only count my asset component.
Yeah, okay, cool. No, I just want to understand, because I mean you don't have a number, that's fine.
And
Because
also when why I find it difficult to like say to like say count the net worth it's because I don't actually view the Bitcoin in terms of the USD or in terms of Singapore dollars or whatever, because the Bitcoin itself is Bitcoin itself. I'm accounting Bitcoin in terms of Bitcoin. If you get my drift on that, it is because if your USD is going worthless, you account in USD also no use.
no, which is fine. Then how do you get 40%, right? So
the 40% is over the years, how much money I've been putting in the income into it, and also
which is again denominated USD, right? So no,
yeah,
I mean the reason why
USD.
I'm asking is because a lot of people who are actually very pro in Bitcoin, right? They actually hold like what again, like 40%, 60%, right, in Bitcoin. But then if you consider that against their cash or their free flowing capital, right, it's actually much more. So I would suppose that in your case is also right, because you only say that you hold like a small amount in like rainy day fund and free, like again your dry powder, your ammo. So I think that's a fair sort of a way. I mean, it's a way to see how someone view Bitcoin, right? And then I think in your case, you understand good enough of the financial system, and also the pros and cons of Bitcoin to actually have such conviction against that. So that's what I just want to understand. And sorry, how do I address you?
Oh, just YCX.
Okay, YCX. I feel like cool. Sorry, Bunty, you're saying something earlier. Sorry, I cut you off there. Go ahead.
Yeah, just now, I think YCX mentioned about the PE ratio, and because of all this Fed printing, PE has grown. I think that is definitely true. If we just look at the PE ratio, definitely shoot up quite a fair bit now. But just keep on. I mean, this period whereby talking about QE, talking about Fed, all this just keep on reminding me of the period during 2008, 2009 when the first US QE, not the Japan one. The first QE actually came from Japan. And then that was the time when you can see, let's say you read some financial news, you always read about, it's all about Fed, market up because of Fed, market down is also because of Fed. That was the period. And in fact, you can see that the Google Trends, right, from let's say 2000, you can see 2008, it peaked. And then after that, from 2009, this period, right, people still talking about like, the whole financial system is breaking, nothing is going well, and then followed by the European crisis, also like it's part of the global financial crisis, right? So the entire period between, let's say, 2010 to let's say 2019, right, is like, I still recall that there are many people that believe the financial system is like no longer working, and people are actually putting money in, some putting in, of course, like Bitcoin, some putting money in gold and so on. But during this period, right, yes, it is true that the incremental money that stimulus or the QE that US putting in has like lesser and lesser incremental value to productivity and so on. But if you just track their earnings, right, let's say you look at this one I'm sharing here on the screen, the S&P 500, you look at the annual earnings. Let's say if we just come out from 2010 and it's still slowly increasing year over year. And many people still refuse to accept that the economy has improved. And even until 2016, I still remember people saying that, okay, this entire economy since 2010 is all fake one. It's all because of the QE. Bear in mind that QE actually lasts quite a number of years. It's until like few years ago, they started to pare down. And then now we are like having another repeat of what's happening. I'm just trying to like thinking, right, whether this kind of scenario will it repeat again, whereby so many people putting in money into Bitcoin, believing that financial system is no longer working, the entire thing is fake, all the PE is so high because of that. These things all cannot believe. We should put in something which is alternative to this entire fiat things, hence the Bitcoin. But what if these things we repeat again? You extrapolate the earnings slowly improving, and then without a narrative that financial system is breaking, right? Then I'm just wondering, new investors, when they have money, are they will still be attracted to put money into Bitcoin or not? Or let's say if you see S&P 500 now is, let's say, 4,000 plus, 1 year later maybe 5,000, then few years later 6, 7, 8,000 people making money in stock market, and then there were just less money flowing into Bitcoin, right? And you know that Bitcoin is not like an investment that give you yield, right? It is like a gold. It sits there in a ledger. It doesn't change over time. So it's really based on the popularity. And the popularity, right, is also depending on whether the price has increased or dropped, like let's say in the past few months or even 1 or 2 years. I mean, if you just look at the early this year when Bitcoin price just shooting up and up and up, right? People start to talking about that it become very popular. People putting money in, feeling that they are genius because they are so smart that they put in money early. But will this trend reverse or not? That's my concern. We're not talking about 100 years back, right? Let's talk about like outlook of 5 years, 10 years. Will there be a scenario whereby, let's say, Bitcoin just slowly up, down, and then end up with, let's say, 15K 10 years later, right? So you are, okay, you can say maybe just end up with a current level, which is fine. You are not losing money. Your Bitcoin, which is counted as Bitcoin, is still Bitcoin. Nothing has changed. But you have been wasting your entire like 10 years by not putting money in something that's more productive, like stock market and so on. So I think that's where the allocations come in, because if you really have to have a very high convictions that either come from the flow or come from some narrative that will getting even more popular, that keep attracting people in, and you actually earn by getting in earlier than others, right? Because at some point these things will peak, and then it's quite tough moving forward, because the narrative has changed, because now money is, instead of flowing into Bitcoin, now it's out. So that's where the problem will come in, right? Yeah, I'll end here.
Okay, so the thing about like you mentioned that yes, the economy will recover, and certainly is definitely possible that the economy will recover and none of the doom and gloom scenario happens. It's definitely possible that happens, but then you have to look at other countries. Okay, when you look at the other countries, are you as a other country that is not the US, are you, and you cannot, you don't have a natural advantage in printing money because you're not the world reserve, okay? And no matter what you do, as you are a small country or whatever, you cannot outprint the US, and the US is able to just keep printing down, and your currency is never going to be able to compete on their grounds. The US will be able to just do that. How exactly are you as a small country going to compete from a currency perspective? That is one other source of demand considerations. It's not just about the US economy. It's because the US is tied very closely to the world, but all these other small economies, they all need to survive as well. And if they adopt the monetary policy of the US, which a lot of them actually do because they have no control over their currency, because a lot of the demand is all coming from the US currency itself, because people are buying USD or things, whatever. They don't have a way to actually take control of their economy. They are not privy to be able to stimulate their economy the same way the US does. And through this currency dominance, there is through this currency dominance itself, right? What exactly is happening is that the US is actually borrowing money from other countries and essentially paying it back with lesser amount, because remember, they print more money, then your money is the money is actually devalued. They will pay you back the amount that they owe to you, but when they pay you back, it's not worth a lot. That is something that is there to consider. And these countries, when they start to realize that something like this is happening, they realize that the US dollar loses one very fundamental aspect of money, which is the unit of account. Okay, it will still function damn well as a medium of exchange. Store of value is a given that is none, because it will just keep reducing. But the unit of account itself, the one that matters in the medium term, in the short term, you will start to see that it loses value. These countries are just essentially just going to lose out on their exports and imports, because they have no choice. They need to do business in USD, and when they do business in USD and they are unable to control their monetary policy, because the monetary policy is just dominated by US, what are they going to do? That you're not a strong economy. What are you going to do? That's one thing to consider, okay? From a demand side, then you talk about, like, say, okay, the economy is growing and things are going well and all. But then if the economy is growing, things and well and all, why is the debt rising? Why isn't the US actually clearing its debt? Why is the balance sheet rising? Why don't the balance sheet actually go down and clear out? I mean, ideally the Fed should not be holding that much. You see all the way back, the Fed likes to hold a fixed amount on its balance sheet. Why is the balance sheet right now just going up and up and up? And why is the debt not being paid down? I mean, to pay down debt, how do you pay down debt? You basically you need to have money to pay down the debt, right? And to have the money, you either print the money or you collect taxes. So you see you collect taxes, and US now is introducing a global corporation tax. You all know about this. This global corporation tax, once it's introduced, it will cut into your earnings, right? So all the equities are being taxed, they cut into their earnings. Then if, let's say, the US really needs to pay down its debt because things are going out of control, it will also introduce other taxes. There can be more consumption tax, like GST, like that. There can be property tax. And then they are not only that, they are also making money hard to move out of their country. You can see all the capital controls that are coming out. All the countries right now, they are doing so much capital controls, like what travel rule, FATF travel rule, whatever amount, whatever those kind of things. These are all to prevent the money from being able to flow out. Don't you find that it's kind of like a very, it's like you are on a poker table like that, and then you all put down your money, and then you just think about, like, the poker table has perpetual cards like that, and then you just keep flipping cards, and then you all just keep entering up to see, the next card, whether I win or not. Then you just keep continuing on this game, and you just keep entering up, and then are you really sure you want to be in this game and then end up on the wrong side? That is the thing, right? And I mean, yeah, the economy is growing and things, and I don't deny that there's productivity increases. There is, but then the debt is not being paid down, and as so long as the debt is not being paid down, the high risk poker game continues. That is the case. That's what the debt is doing. Debt is the leverage.
Yeah, I'll just give a quick comment on the debt, right? Because it sounds like it is such a big deal that US government sorry, there's some echo. That there's such a big deal, right? But if you just look at the US debt, I mean, of course, it is increasing every year because everything increased, right? The economy increased, population increase.
If debt, why would economy increase lead to debt increase? Shouldn't economy increase lead to the government paying off its debt? Like Singapore pay off its debt, right?
It doesn't necessarily need to be so. It doesn't necessarily need to be so because your unit of measurement right now is the debt to the GDP, which is something similar to like our debt to EBITDA in financial terms. But you also need to like judge it against something else, like let's say a debt to assets or debt to equity, and then see how it goes. Because in a certain way, you're taking on more debt, but you have to see what you put that debt into, whether it's actually productive or not. And I don't have the data to show, but if you go to Statistica and then you take a look at the debt to equity, right? It's kind of stable over the past 10 years. It's like up and down, up and down, up and down, which is a different story altogether because like good capital allocators, the equity ones, you look at the famous one, let's say John Malone, cable cowboy, who is famous for all the US cable companies such as TCI in the past, Discovery right now. He's famous for leveraging up since the 1970s. So his general idea is you want to acquire something, debt to GDP, not debt to EBITDA of about 6 times, which is to a lot of us super dangerous, but he'll reduce the debt to EBITDA down to 4 times. All right, and then he'll look at what to do with the money to actually lever up again to actually buy something. So not to say we shouldn't pay down debt in a certain sense. And I do remember in the past, like some instances, maybe in the 1990s or something, like we do see that these debt to GDP actually go down here and there. So Bunty, back to you.
Yeah, exactly. Because when we talk about debt, right, personal debt is like I borrow money to buy a house, this personal debt, right, versus a public debt, the government debt is totally different kind of things. For government, you don't really need to pay down the debt because that is not how the system works. The system works such that as long as they are sustainable, and by sustainable, what I mean, you can just take the debt over GDP, right? As long as it's within a percentage that is sustainable. Let's say like now you can look at the screen that I'm sharing since 2010, 85% to now 98%. Yes, it has increased for sure with all the stimulus, but this is not to the stage where everything is not sustainable, right? So that's just a quick comment.
Okay, then some other counterpoints to this is that if this is the case, why is it that the Fed needs to have so many new measures of printing money? Or why don't the Fed just change the interest rate?
Yep. Let me just comment on Fed action because I think in your earlier talk you talk about like these 4 measures about like Fed printing, then you mix it up with the fiscal stimulus, or the stimulus check, right? I think you need to understand there are 2 different types. One is on the monetary policy, which control the interest rate and mainly to control to manage the unemployment and inflation. The second part is on the fiscal one, which is all the tax and also stimulus and government spending, right? So back to the Fed, why they are still doing all the QE is because it's a form of like monetary easing, right? By easing, what it means is that they want the interest rate to be lower because now the economy is still in the pandemic and maybe not recession, but economy is not doing that well, just to put it short, is that. So what they want to do is lowering the interest rate and then make sure that at least we get out from this trouble. And how they are doing that, okay, there are 2 ways, right? Mainly they control the short end, the Fed fund rates. And that one is only the short rate. They can't control the, let's say like the 10-year rate. But the 10-year rates, right, also affect other, let's say, for example, like the mortgage and so on, which is the longer end of the yield curve. So what happened is that they just use this QE to lower down the long end rates as well. And then if you think about it, right, the 10-year, what they do with the Fed, sorry, lost my thought. Actually, they just want to like boost up the economies using that lah. And the QE, right, when I think we tend to use like the money printing as if like they are creating money out of nowhere, right? Actually, that is also not true, because what happens is that on Fed's balance sheets, right, it works like opposite direction of government or government balance sheet. On their balance sheet, the Fed, they actually, yes, they created, but they do an exchange, right? So they created this money, the digital money, meaning just numbers in the record, and then they exchange it with the government bonds on the open market. So net, right, there is like asset increase, liability increase, the net assets or the surplus doesn't change, right? So I think that one is also quite important to note now, because ultimately it is not with the intention of increasing the money supply, but to lower down the yield and the interest rate, so that corporates can do better, because while the interest rate become lower, then you have extra money. Instead of spending on the cost of financing, you actually have extra money to do other stuff, to expand, right? So that's what I mean by using the monetary policy to boost the economy lah.
Okay, then why is there a need to actually pay back? Like, is there a need to actually raise taxes?
Okay, that's why I said there are two parts, right? If you talk about the fiscal side, right, what they want to do is just to make sure that this debt over GDP is sustainable. So if they continue with the current spending, and if they still want to maintain at this level, and they don't want to cut the expenses, right, then what they can do is increase their revenues through taxes. This is definitely one way. The alternative is that, okay, they can just reduce the spending, reduce the government projects. That also will help to manage this percentage. That there isn't a goal to bring this 98% to 0%. That will never be the goal. But if let's say this 98%, right, let's say it stay between below 120%, between 80 to 120% in the next 10 years, I think that will be considered a job well done. So this is on the fiscal side, meaning we are talking about the government balance sheet. But on the Fed balance sheet, it's totally different things, right? Because like I said, Fed is just control the monetary. If they stop their QE and then let the QE hold the bonds holding that they have just to run off, right? Then the Fed's balance sheet will just drop. And this is also not something that is new, right? Because it happens just before the pandemic. Fed balance sheet has decreased before. And that decrease, right, is like it's just like the opposite of what's happening when they do QE. So QE is easing. Then if they just let the bonds run off, right, then it is a form of tightening, because once they let the bonds run off, you have one less bias, right? The bond bias, which is the Fed, right? And then they are basically become a seller, or run off is also considered like a form of selling also, right? And then what happens is that there is more supply of government bond and less demand, and the price will drop, right? And the price will drop means that the interest rate will be higher. Interest rate higher means that there is a form of cooling, right? The monetary cooling. So that will be imposed once the economy started to improve, heated up, and you can see the inflation already flowing into the daily, the CPI and so on. So basically, they are using the QE together with the Fed fund rates to actually control how hot is the market, right? Because if the whole things, they just keep on doing easing and non-stop, and the whole stock market, everything become a bubble, that is also will lead to unintended consequences, right? So these are the levers that the government pulls. So it's totally different things, right? The monetary versus the fiscal. Both will have the impact to stock market, to even Bitcoin, or the commodity prices and so on. But it's just like the mechanism work like differently. And they have their own goals, right? Like the government debt, please don't expect they will pay down the debt, because the whole financial system will just stop working if they pay down all the debt,
Yeah,
it is not designed that way. Yeah, that's what I'm trying to say.
Okay, then the thing about it, what do you think about how much of the stimulus, whether fiscal or monetary, right? How much of it is actually going towards productivity growth, and how much of it is going towards consumption?
Well, this one I don't have the answer because you need to have a form of measures to say whether you can see the productivity growth or not, right? Because we know how they spend. This one you can look for the 2 trillions or how many trillions stimulus, all the bills that they just passed, right? How they spend the money, government spending, all those things. If you just mail the check to the citizens, they just do the spending. Of course, those will consider consumption, but they are also spending in the form of, let's say, infrastructure. Even if they have a project with, let's say, AWS and also Microsoft for the cloud project, government spend the money and then eventually leads to a much improved infrastructure, right? When it comes to cloud infrastructure, to me, that's one form of productivity also. But this kind of things is really not as easy to just say, okay, this one, once you spend $100 into government cloud infrastructure, that's productivity already. That is not as straightforward, right? Because ultimately, after they spend, then the money will flows, and then there will be contractor, and then there will be subcontractor. They will do different things. Some of the projects that they are working on will improve the infrastructure and will lead to higher productivity, right? Like for example, instead of on-premises now, they move to cloud. And then by using cloud now, things are moving, let's say 24 hours, less breakdown. All these things will actually lead to some productivity gain. It's just that you won't see it right immediately after they just pass the bill, right? Because these things take years to play out, right? And then it also depends on whether you have enough skillful people in the country to carry out all the projects that will improve the infrastructure, which then leads to productivity gains, right? Some will they talk about the infrastructure spending. Maybe they will improve the airport or the road, right? I mean the port, all these things. It also will improve the productivity, but you don't see it now, lah. I guess at least 3-5 years to see any effect, right? And then at that time, people can start to debate whether this like that spending, whether it is good or not. And even with that, right, you also can't tell, like, because we don't have an alternate universe whereby they don't do all this spending, right? We don't have that. You don't even know. Let's say I look at the numbers, for example. Okay, productivity gain is, let's say, average 1% for the next 5 years, right? Now we are at 2026, like 1% gain. You don't even know, like, if they don't do all these things, what will be the gain, right? You can't say that if they don't do all this spending, the gain will be 0%, hence it is +1. It's not the case, right? It is also possible that if the government don't do anything, the productivity gain can be -1% also, -2%, who knows, right? So I think, I mean, it will turn to become like an academic debate if you talk about all this spending. But I think ultimately, you want to know whether the government does the right thing. You just have to observe around, right? Our lives breaking down. I mean, definitely there are countries is like that. Nothing is right. Everything is just like, okay, haywire. But there are also, I mean, if you just look at the largest economy, you can, I mean, US, China, even you can include Singapore, Malaysia. I mean, you can still see that things are still working, right? Nothing is perfect, but I don't think like it is to an extent that you need to like get out entirely from this entire system and build an alternative, right? I mean, it's always good there is innovative solutions or this Bitcoin. I'm actually very pro of this. It's just that I don't think it is, the thesis is as strong as we have to just give just give up everything that we have now, including all the system that we have now, and just move on to the new one, right? Of course, there are people that is very pro lah. I think that's fair lah. But then it's not like totally end of the world in terms of the current systems. I'm on the optimist side lah. Just
do you think that the monetary policy can continue being so loose?
We definitely can see that with this loose monetary policy, we can see the effect already. In fact, for example, like like all the Wall Street bet, all these things, right? Bitcoin go up by 300%. You can see the real estate housing prices, stock market, the kind of PE that was growing, the chart that I just showed just now, right? 34 PE. This is like super high already, no doubt on that. We can say that if they continue with this for long, of course, it will end up getting bad because imagine that you're paying $34 for $1 of earning, and then you just make the entire system more fragile, right? So I think, in short, is that they can't just continue these things forever. This is for sure. But
okay, so if let's say the monetary policy at some point, the Federal Reserve has to tighten the monetary policy. I don't know through what way. Okay, they have to tighten because I agree with what you say about productivity and all, but monetary policy if you just let it be loose for a prolonged period of time, what will actually happen is that the debt fueled growth, which is consumption, right? Consumption will always increase above the productivity gain because that's the reason why you start to see inflation, and that's the reason why you need to lower it down, because if you don't lower it down, then that's going to happen. The consumption will just keep increasing. Too much money, and no matter how productive you are, you cannot like suddenly say I'm going to increase productivity prolonged period of time at an ever increasing rate, just like my inflation. I mean, just like my interest, just like my Fed, the monetary policy like that. That is one thing I believe in. I don't have the data to back this up, but the way I see it works, right, is that productivity, there's a hard cap to it. It's not like you can suddenly every year your productivity go up by a lot. Because productivity is real growth, and real growth is increasing, but not necessarily increasing to the level of the money growth increasing. That's what I'm saying. Then the thing about you mentioned about all those Wall Street bets, all those things. The thing is, like also what I don't know what his name, numbers, SCG numbers. SCG numbers said
Hayden.
Okay. What Hayden said is that the banks, all these, they have a lot of all these requirements and all these. But you just see throughout history. This is requirements just keep increasing. But somehow or rather, every other 10 years or plus, you start to see something. You start to see that there's always something that goes out of the gap, some kind of mispricing or misallocation, and then there's going to be a cascading effect. It just happens. Like the property, everyone think, property can only go up, and property are investment grade and that kind of things. And then just from that one thing itself, with all the leverage built into the traditional financial system, even with all the whatever regulations built there, then something like that will happen, and then it will come cascading down. And if you are holding on to a lot of money, and then you see your money cascade down, especially if you are not holding just your own money, you're holding other people's money. Okay, you are a fund manager, you're holding hundreds of people's money, with many billions in it, then you start to, oh shit, what am I going to do? I better. It's not like you have a choice, you cannot say, never mind, I'm going to hold, and then 5 years later I'll be in the green again. You'll be like, oh shit, I better sell now and take the loss. It could be a loss now, but I mitigate my risk, because this entire thing is a risk thing. I'm not, if suddenly things drop by 20%, and I can get out and only lose 20%, I'm not going to risk it and lose 50%, because I'm beholden to other people. That kind of things that can happen, and that is what caused the leverage, the cascade to happen. And this kind of things, I don't know what sector it will happen in, but I know that just look at throughout history, the past 100 years, it's always a boom, bust, boom, bust, boom, bust, caused by whatever event, boom, bust. There's always going to be a boom, bust, and that is how a financial system that is built upon this debt, built upon this collateral, built on this leverage, and built upon this counterparty and custodian risk is there. That is what I know from history. Okay, that all the other metrics like what you mentioned, I all agree with you that it will go up, economy is doing well and all. But to say something like, oh, the debt itself is okay, that is okay, that is a very modern monetary theory, modern monetary theory, which to be honest is still not very proven yet. And when you are
that one is the extreme version, the modern monetary theory. Not to that extent, but that's the extreme.
And that you know, you can continue on this charade. This I call it a charade because everyone do together and we all do together. Some person along the way will start to think, hey, fuck it, this is too risky for me. I better secure myself and get out some amount. Then someone else will start to think, hey, I'm also seeing weakness. This game cannot go in forever. I better also secure something. And once people start thinking like that, that I better secure something. This cascade effect will appear, and then you don't want to be the last one to say, oh, I'm the one who's not securing, because if you are the last one who's not securing, you're going to lose a lot. That is the truth. And yeah, when things are going well, everyone say, oh, good, Federal Reserve doing good. 2004, 2005, 2006, all doing good, very well. Nothing can happen. But when it happens out of nowhere, and you won't be able to see it coming. That's the thing. All the metrics that everyone has is not even enough to predict that the Great Recession happened. Or it's only like, and even if you can predict that there's something like that is happening, like Michael Burry like that, right? Do you are you able to take advantage of it? That's another thing. Then another thing is not only that when it will happen, you also don't know. Okay, then these are all the things that are there. And my investment, I mean, this ultimately it comes down to the first question that I asked at the whole start is, why do you invest? You invest to grow wealth and to protect wealth. If you are 100% grow wealth, go ahead. Anything, go the riskiest one. But then there are people out there who is, hey, I have 100K, I have 200K here. This 200K I earn over, I don't know, 5 years or something, or whatever, and it's supposed to last me for my retirement or things like that. I want to protect my wealth, like how am I going to protect my wealth? That's a question, Like, I'm okay with economy dropping and all, but what will happen if, let's say, fine, economy drops, then after that it recovers, but then I start to realize that everything rise in price. Like my KFC went from $4 to $8, and then like, hey, I start to realize that the amount of money that I put, the allocation, the 1,500 that's supposed to last me per month, that can buy this basket of goods, no longer buy this basket of goods. These are all questions that are there that needs to be addressed, and yeah, ultimately it comes down to, why do you invest, and then whether you want to consider other things that can help you store your wealth in that way, that it's just this fundamental, comes down to this fundamental, all the other metrics is like what you said, there's no alternative universe to see it.
Before Boon Song speaking, right? I just want to say, I'm just want to be aware of the timing. I think we can get to one or two more questions then, because I start to feel hungry already. Time for lunch, right? Because okay, Boon Song, go ahead.
YCX, I don't need a very long answer for you because we kind of been going on for 2 hours almost. So when we do any kind of investing, there's always a point where we know that we are wrong. So how do you know that you are wrong? I don't need a long answer, just maybe 5-6 lines will do.
Okay, so how do I know whether I'm wrong? The thing is, I believe in the fundamentals of this hard currency, okay? And because I believe in the fundamentals of this hard currency, it doesn't matter to me whether if today the price dropped from 34,000 down to say 10,000. It is fine for me. That is the thing. I don't view my wrong in terms of the price. Okay, the only way I will see whether I'm wrong is if the fundamentals of Bitcoin has changed, which is that some other better coin appears, but that's not likely because the security is the strongest on the Bitcoin network. Or yeah, basically I see that it's not likely from a game theory perspective. I will still hold the Bitcoin, and the Bitcoin is a immutable thing.
Thanks a lot. And anyone else? Maybe one last questions if there's any. Okay, no more questions. Yeah, thanks a lot, YCX, for the like very detailed thesis on the Bitcoin. I think I'm okay. I invested a bit on Bitcoin, but I'm a bit like sometimes skeptical. Sometimes I do buy a lot of arguments that you just say. Like I think the first, let's say 40, 50 minutes when you are talking about giving all the stories, right? I was just nodding my head because I think there are some truth in it. I agree with most of the points, but of course, for the sake of discussion, have to be a bit more critical and ask some questions. Not that I'm like disagree with what you say. Yeah, thanks a lot so much for sharing with us. So, and I will just, by the way, I'll just share this recording to the group for those who didn't get to join. Yeah, YCX, any closing from you?
Yeah, thanks for organizing this as well. Yeah, closing statement is more of like really is one of the key phrases in Bitcoin, which is that not your keys, not your coin. If you don't own your things, you own everything through custodians, right? Then the custodians, their number one interest is to protect themselves, not to protect you. Yeah, protect you only comes number 2 or whatever. So yeah, remember that whatever that you put your money into through whatever things, there's always counterparty risk. You might think that you might not be exposed to debt if you don't have debt. You might not be exposed to whatever, but the counterparty can be exposed to it. The companies that you buy, they can hold a lot of debt as well. So they are all exposed. It is really all built on top of debt and all built on top of this leverage. Okay, that's all.
All right, then we'll catch up again. Let's say next round, if let's say anyone has any topic or we want to continue with this topic, I think during weekends, if everyone is free, we can still have a session like this, yeah? Okay, thank you so much for joining. Let's end the call here and go for the lunch. Thanks a lot.